some of the growth potential of emerging models that are out there, some promising investment sectors that seem to be doing well right now and have some future growth in them as well. Some evaluating of the startup viability. We'll look at some of the investment strategies that are in there around these startups and a little bit of about disruption and value creation as well. So what we're going to look at is basically the characteristics and growth potential. What are some of the key features and growth drivers of new business models? Those promising sectors, what are the high potential industries for investment? Some of the metrics that we'll assess startup success by, and some of the investment strategies that we'll look at by adapting to new business landscapes. It's a quick one today. So if there's anything you do miss, this will be recorded and put on the YouTube channel straight afterwards as well. So the characteristics and growth potential we look at here is around innovative approaches disrupting traditional markets. That doesn't have to be Uber, Airbnb, and Zoom calls, for instance. It can be something as simple as digitizing a previously very manual process. In the case of Go Locum, which is an investee of Paspalis, we have invested, a fair bit of money into helping them to scale an idea that takes a very laborious, long, and slow process, such as onboarding locum doctors to hospitals, into something a lot less laborious and a lot less requiring of labor and time as well. And it's made a really big difference. They've already got lots of traction. So we look at them as an innovative approach that does disrupt traditional markets. In the case of scalable models that leverage technology and digital platforms, our investment in Wanna, which is a digitized way of authorizing the access of people who don't have a lot of identification. So in indigenous remote communities, for example, getting them to be able to do banking and different things that require them to, number one, prove their identity, but secondly, improve things like bloodlines and ancestry and access to royalties as far as land rights payments goes as well. It's a really interesting model because it is thoroughly scalable. It's digital, and that's where digital has become so important in so many forms of investment, simply because it is the one thing that is the most scalable there. Some of the key characteristics of these new business models we're seeing, there is a definite scalability there, something which is going to allow you to go beyond just a very small segment of customers. There's a lot of flexibility in there as well. So for instance, because it's digital, you can make rapid changes if you need to make them. If the business model has to change, if the assumptions you made at the beginning have to change, there is some flexibility worked in there as well. It's not like you're building $100 million of infrastructure that physically can't be moved, changed, or easily changed, at least, not without spending another $100 million to do it. The innovation play, which is about, what is something in here that hasn't been solved? What's a problem that hasn't been solved or has been solved, but we've got a new approach to solve it with? Then we move on to the technology-driven side, which is all about the ability to be able to then move on to, just adding technology where technology may not have been there before. And then the customer-centric model is taking previously very, very bloated places, like particularly ex-government enterprises, for instance, which have inherited a lot of bloat and a lot of slowness to market, and they then spin that around and turn it into something a lot more customer centric. So rather than the example would be the difference between Telstra and Optus. When Optus first came to the market, they saw that there was a real customer focused loss when it came to Telstra at the time as the incumbent government owned enterprise. So they looked at it and went, well, where telecom's always saying no, we say yes. And that became, until still is to this day, their catchphrase of yes, we say yes when others seem to say no. So that's a lot of the stuff that we're seeing emerging. High growth models you might see and recognize as things like Uber. Yeah. So they're a ride sharing leader who was able to take the taxi industry and say, well, we will provide something which is not just different to what's currently being done. So it allows you to track your taxi on the way, you know who it is, what car they're coming in, so you can then spot that rather than just someone randomly turning up. They then take that and said, we can scale this to other markets. We can take this to other countries. We can take this even into other sectors like food delivery. Another example, I mentioned it before, Airbnb. So instead of hotels, which have a certain amount of inventory, which is then offered at different rates depending on what the demand is, much like Uber's surge pricing, Airbnb has takes that away and says, well, basically, we think that there's room for scalability, and there's a room for a lot of growth because you go to any one particular highly popular vacation spot, say the Gold Coast, for instance, and all the hotels are booked out. What happens then? Do we just stop letting people in? And then Airbnbs will like we can open up unused inventory in homes, where they're just rooms or whether they are whole houses where people can stay in an alternative form of accommodation that wasn't there to begin with. And that high growth meant that there was a new industry emerging. So people were able to make money where they previously couldn't out of their unsold and unused inventory of rooms and spaces in their homes. So that was a whole new industry emerging. Shopify took the idea of e-commerce and systemized it and standardized it and make it really simple. Well, as simple as they could. It's not simple for everybody, but as simple as they could and effective as well. And then adding on the fact that they could go, okay, there's a lot of growth here if we can just make sure we integrate with everything we possibly can. And Shopify has done that in a way that pretty much no one else, but perhaps maybe WooCommerce, which plugs into WordPress, does. But brand wise, WooCommerce is known to WordPress developers, but to pretty much no one else. Shopify is much more known because it's now a front end, it's a payment system, it's something which has become an industry and a sector of its own. Netflix, they took the idea that people don't want to have to watch things when they're told to watch things. They want to watch things when they want to watch things. They took the idea of people, being able to go to a movie rental store and then digitize that. And well, the results are very clear. They are the biggest out there, and they don't look like they're going to be overtaken anytime soon. And whilst there's a lot of other consolidation in amongst other streaming giants, everyone from Paramount to Disney Plus to MGM and different streaming providers that we don't even get in Australia, that consolidation isn't affecting Netflix. Netflix is doing pretty well. And then Zoom, they got a high growth model because they came in before it was actually a very highly necessary technology. They came in with an idea of making it super simple for you to join a video call and then providing the back end infrastructure to make those video calls as reliable as they possibly could and as simple to join and simple to host as they possibly could. Usually click on the link and you're in. Now, there was some security problems once, the world went crazy in 2020, and they were sorted out very quickly. The privacy was added in, and there's still a lot of growth in there. Now, Zoom isn't growing anywhere near as fast as what it did. But what they're able to do now is take that built-in reliable audience that they already had and monetize them a little bit more so that you don't get quite as much for free as you used to, but you get the offset of a lot more features if you choose to pay for that service. So, some sectors that we're looking at as very promising for investment, there's always the classics, technology, right? There's a lot of growth in AI, machine learning, and automation. What we're seeing, though, is a lot of that's consolidating into certain players that then use their technologies as API connections to others to build their own technologies on top of. This has been enabled by the expansion of cloud computing because all of this AI stuff is pretty much done in the cloud. Some limited stuff is done on device, such as Apple doing some work on their devices, and I think Samsung also does a little bit of work on their device. But by and large, most of it's done in the cloud. And I suppose then it also came about because there was a lot of unused capacity as a result of the failure of NFTs and the Web3 to really take off and become part of the mainstream. So that whilst Bitcoin mining is a thing and uses a lot of graphic processing units, a lot of NVIDIA chips to be able to do that, that then, as it lost its shine, left a whole lot of unused capacity in cloud computing, which is now being turned around. The same technology can be used for processing AI and machine learning and building large language models, such as one like Open AI and Google's Gemini and you name it. That's what these are. Now, cybersecurity is also an area that's very, very interesting. Those who can somehow produce a method to intervene in cybersecurity issues or make cybersecurity as simple as possible without making it ineffective, we're kind of still waiting for that to come. So there's a lot of people who are starting cybersecurity firms, but it's still very much about basic desktop support and monitoring network traffic. It's not really about solving the last mile home, which is the human factor. That ability to be able to automate away the human factor is still a long way off. So if there's something that comes up, or if you got an idea for that, hey, we'd love to hear about it. The next sector is sustainability. With sustainability reporting in place in the EU and coming to Australia as well, there's a big demand for not just renewable energy solutions and sustainable practices, but also carbon trading, producing different ways of doing carbon, from blue carbon through seagrass fields and the restoration of mangroves in places like Pakistan's Indus River Delta, right through to startups here in the Northern Territory that are looking to protect the mangroves that are already in place here in the Territory, to be able to take that and make that an effective carbon trading scheme, to be able to give remote communities another place where they're able to make some money. So it's great. There's an innovation there in recycling and waste management technologies, being able to take on things that have previously been quite limited. So the ability to be able to take and produce new items. So take tires, turning them into road surfaces, taking plastics and turning them into playground equipment, anything like that that's got some kind of application from where you would take a previous waste item and turn it into something useful. That is where there's a lot of money ready to be sunk into. So not just taking waste prevention, which is also a great thing, but also how do we solve the problem of the waste that's already in the system, and building this circular economy. So there's not a cradle to grave of every product that's made, but a cradle to cradle, that something can be indefinitely used again and again and again. Our third area, a sector of interest, would have to be the whole idea of healthcare. We're an aging population, and that's not just Australia. There's an aging population in China, which has become quite a crisis for that country. Japan is most like well and truly into that crisis. South Korea is having um, a very big issue with their aging population, where their population now is such a point that it's not replacing itself, and they don't have strong immigration like a lot of the Western nations do. So they've got a real issue with a declining population. So how does that affect the economy? How does that affect how things are getting paid for, and the healthcare in general for older people? When if you've got 70% of people taking, all the healthcare facilities, but only 30% of people paying the taxes to pay for that, that becomes an issue. So, what can we see that's on the horizon for advancements in telemedicine platforms, digital health platforms, biotech and personalized medicine, getting to the point where you don't have to go to a doctor to receive a one size fits all treatment, but something that's very specifically personalized for you? And e-commerce is still very strong. That integration of online and offline shopping, this is what is very interesting. Not just that idea that you can start up a website and sell things online, or just have a shop that's got bricks and mortar involved, but the integration of both of those together. So far, the leaders in that space have been Shopify and Square. They've been able to do some great things, which saying that your point of sale system in your shop connects to your same inventory as your online store. That's been class defining when it comes to e-commerce. But we're looking at who else is going to be doing that, because both of those are getting more and more expensive and harder to use. So who will come in and disrupt that? We're interested in seeing that. Bit of growth of brands selling directly to consumers as well. We're starting to see, even in the area of food delivery, of restaurants that don't exist providing delivery services. I own 3 cafes in Queensland as well, and all 3 of them do that. The cafes are mine. They operate during the day. At night, some Uber Eats restaurants move in, and they are able to then use that space as an Indian restaurant, a Mexican restaurant, a pizza, burgers, and pasta restaurant. And when they close up just after midnight, my guys come back in at 5 a.m. for the cafe side of it, and it becomes this appreciating asset all the time, rather than having a place which is empty from 3 p.m. through to 5 a.m. the next morning. You've got an asset that's actually producing for you again and again and again. So in that area, we'd like to see some of that, who is revolutionizing that, who's taking something new from that other than just replicating Uber Eats and DoorDash. So how do we evaluate the viability and scalability of these ideas? Well, there's got to be some profitability, or at least a pathway to that profitability. What is the total addressable market? What is the size of the market that you're trying to serve? Is this just for a couple of thousand people in a town, or is this something which can be scaled to a national or international scale where the earnings are going to be far greater than just what you can put in a local area? And that speaks to scalability as well. Do you have a model that can grow? If digital, yeah, it probably can. Cloud computing allows you to infinitely scale these days. But if there's something which you've got, which is producing a physical product, you can only maybe produce two of those per day. What can you do to get that to the point where you can produce 2,000 of those a day or 2 million of those a day? How scalable is your production? The customer acquisition cost is something we love to keep an eye on. And we definitely look at this when it comes to people who are selling physical products and services online as well. If you've got an AI image generation product that you're selling and your customer actually, what you're going to make is $29.95 a month, but it costs you about $80 to get each customer in, it means you're not really making any money on them for a number of months. So what we want to see is a pathway through to getting that customer acquisition cost down. And I know when startups are very new, they tend to have to spend a lot of money on marketing. But when they're not so new, we expect that CAC to come down significantly. And then the retention rate. Are your customers staying with you? Is there a stickiness to your service? And that doesn't mean just simply throwing in a subscription cost. You know, subscription costs are great, and that's the model that's very, very well worn and used to be able to keep people associated with paying for a service every month rather than paying for once off. And by and large, the market has accepted that. But subscription services also are very easy to cancel or not come back to. I do the same when it comes to all of my online streaming services. I haven't used Stan for a while since they stopped making new episodes of Suits. So I've sort of jumped off that and I've gone over to Netflix. Now, the minute the Netflix doesn't have anything on there that I want to watch, I cancel it for those months as well. Jumping over to Disney Plus, I'm only ever active when there's a Star Wars show on. The Acolyte just ended. I don't know when the next Star Wars production will be, so I will cut it off from this month coming onwards. The same with any of those. So you just got to make sure that there's some kind of way to keep those customers active and paying, even though you might have something like subscription costs that would incentivize them to stay with you anyway. So a case study of a very successful startup, we don't really have to talk too far to know what SpaceX is, right? Elon Musk's, he revolutionized space technology, space exploration by making rockets reusable. So instead of second stage rockets just falling to Earth and burning up or landing at Point Nemo in the Pacific Ocean, they now can land themselves and be reused, which brings the cost of the next mission down quite considerably. Achieving significant cost reductions was just the beginning because he then was able to secure contracts with the big players like NASA and a lot of private companies as well for getting satellites to space. Not to mention his own Starlink satellites that are producing basically a replacement for the world's telecommunications networks to put them in the hands of essentially one person. He pioneered the development. Now, he didn't do this himself, of course. He did this with a team of very talented people, but he was the leader who sort of led that, right? So he pioneered the development of interplanetary travel ambitions. Before that, missions to Mars were kind of thought as fanciful. Now it's going to happen in a matter of years. So it's something which has gone from, this is something that we maybe think will happen in the far sci-fi like future. Now it's something which is just about to happen and will happen in our lifetime. So some of the common pitfalls you want to avoid when it comes to choosing a business model for a startup would be, well, very much that lack of market research. You do not want to go in blind to this. And this is something we definitely find, and I did it with my first startup. My first startup, I did not understand what the customer needed or what the market was like. In fact, I didn't even ask them. I went in with an assumption that this was something they would want and they would need. They didn't. And it ended up being a mess. I lost a lot of money on it, and it could have been avoided if only I had done real market research into that customer segment. We also find that the lack of market research is reflected in some real limited awareness of who the competitors are out there and what are the obstacles they had to overcome so that you can avoid those obstacles as well. And I think it's a little bit of wishful thinking, and the entrepreneur tends to have a little bit of an optimism bias, which we think, well, things will just go fine because we've got talent and we know we've got a hunch, and our hunch never lets us down. But the problem is hunches not data. We prefer data so we can see who those competitors are, so we know that you've got an idea in mind to work around them or work over them, work under them, or do something that's going to allow you to enter that market without too much of an obstacle there. The next bit is over expansion without stability, and that's scaling yourself up way too fast before you've got that solid foundation in place. And this often is what uses up runways of cash and destroys your cash flow. We're talking about, for instance, taking something which works in one location and growing it out to 30 locations. A perfect example of this going horribly wrong was Masters Hardware. It was supposed to be Woolworths' way of taking on Bunnings. Bunnings was pretty much it destroyed the rest of the hardware industry. There was, went from having Knock and Kirby and BBC Hardware and Home Hardware and Mitre 10, and now it's pretty much it's just Bunnings everywhere, right? We've followed that same path as America, where everything's gone into Lowe's and the other one, Home Depot. So when you see that whole consolidation of industry into just a couple of players, that's when we start to see that it's going to be very hard for someone to come in. Now, Woolworths came in, they teamed up with a team from America who was behind the Lowe's concept, not Lowe's as in the clothing shop, but Lowe's, the home improvement store in the US, and tried to do the same thing in Australia. They opened a lot of stores very quickly, spent a couple of $1 billion building those stores. And within 10 years, the entire thing had come crashing down, wasn't making enough money, expanded too fast, and put way too much strain on the resources of the company. And they just were never able to deliver quite the same as what Bunnings was. In fact, with Masters around, Bunnings didn't really lose anything because people had already chosen to go to Bunnings. They got used to the Bunnings approach and they liked the Bunnings approach. Number three, poor cash flow management, kind of related to what we were just talking about. Very inadequate budgeting, very poor financial planning, and failing to stay on top of things in their day-to-day operations, spending too much, not balancing that out with what they're making through revenue, going into debt and continuing to mount that debt up. That's just this is very basic 101 budgetary stuff. Unfortunately, it's not treated as one to one or 101 by a lot of people. They will see it as, oh, look, I'm a visionary. I'm not really here to take care of the money, but someone has to. So if we don't see teams that are starting to be developed within startups that include the business manager who has an eye on this stuff, then it leaves us feeling a little vulnerable. Number four, ignoring customer feedback. That is the greatest opportunity for you to improve and to make sure you keep your customers happy and retained in your business. Not having a mechanism for customer feedback is death knell for any business. It leads to a loss of trust in you. It leads to a loss of loyalty in you. And you never ever fixed those unaddressed issues because they just keep going on and on and on. You keep having to pay 6 times more to get new customers in when it could cost you a whole lot less if you just made the ones you have happy enough to stay with you. Number five, failure to adapt to changes in the market. Inflexibility, adjusting strategies to evolving market trends. Lest we talk about Blockbuster Video and Video Easy, or lest we talk about any of those large scale, iconic retailers that have gone from the past that weren't able to survive. Dick Smith Electronics would be another example of those, just could not survive in the current retail landscape as things sort of came to a point where medium-sized stores, Brash's, for instance, or Chandler's, don't compete enough with those big box stores to be able to stay relevant, to stay open. There's a risk of becoming very obsolete and very, very yesterday's hero and losing relevance over time by not keeping up with the market. Now, that may mean you have to consolidate down to a smaller amount of stores. That may mean you have to rebrand, change your focus, sell a different product, or move to different locations. Or it may mean moving online, digitizing, not being so reliant upon the bricks and mortar operations. All of those could be ways that you can avoid just simply by staying on top of where the market's going. A very long time ago, Blockbuster had the opportunity to buy Netflix. Netflix wanted to sell to Blockbuster. Blockbuster didn't because they thought they had an unassailable lead in their space and this internet thing was just a fad. Well, we know what happened in the end there. Now, how do we align our investments with these different models as they're approaching. This is where we look at strategic investment alignment. So as an investor ourselves, we look at adapting investment portfolios to match the current market trends. If there's AI happening in the world, we will look at AI. If there is critical minerals lists that the government's starting to form, we're looking for those who are working in that as well. That's how we find the opportunities and how we align them with those business models that are coming through. Are we looking for people who are going to charge a subscription rate for everything they do? Not necessarily, but we would look at, does this particular business have the ability to be able to skip between different kinds of business models and different revenue models if the market needs them to? So we're looking at that flexibility, that ability to be agile, to jump from one strategy to another. So we would say make sure you do your industry research. Make sure you diversify your investment across promising sectors. We certainly do that in all of our investment decisions we make. We don't overinvest in any one sector in particular. A lot of the big Australian venture capital firms tend to be very focused on one particular area, very much into technology, and that's it. So we make sure we're not like that. We don't just go into one area because it makes you very vulnerable to market changes and also the taste of investors. Number three, leverage technology and innovation. What have you got in technology that helps you to digitize like Go Locum did? What have you got that helps you to leverage technology to reach markets that were previously unreached, like Wanna has been able to do? And fourth, monitor and adjust your strategies based upon the changes that are happening. And to do that, you've got to keep an eye on the market. I know you don't want to sit there reading the Australian Financial Review every single day. I don't want to either, but I work in an investment firm, which means that I have to look at what's going on in the market. So it means reading on that, knowing what people are talking about, understanding that when an investment manager is talking to an investment due diligence officer, that I understand what those conversations are and what the implications for those things are. Because I'm going to advise a startup on how to move through this system, I have to know the stuff. So make sure you can have a way of doing that, because you need to have some kind of way to manage the risk, not only in your investment portfolios, but also in your career and your startup. So what you want to do is make sure we spread our investments across different assets. We certainly do that as an investment firm, and you find that most investors do that anyway. Monitoring the market volatility, again, pick up the Australian Financial Review or look at Yahoo Finance. Yahoo Finance, by the way, is probably the best source of that information online. The Yahoo itself is utterly irrelevant, but Yahoo Finance is that one part of that system that really works well. Strategically adjusting your portfolio allocation. We certainly do that when there's different changes in markets, when there's different changes in the investment landscape. We move our investments around to be able to best take advantage of what's going on right now, because there's always long-term and short-term things to look at. And then using really effective ways to hedge strategies so you can't, well, you're not ever going to completely avoid losses, but you want to mitigate those. So any one investment fund may have 6 different investments in it. One or two of those investments could be amazing and they've produced like outsized returns. Meanwhile, one or two of the other investments have either made a loss or just broken even. So that's just pretty much how those investments funds work. Long-term versus short-term, look, they have their pros and cons. Long-term means stable growth. So we talk about things like property. It tends to be resilient to fluctuations over the long term. Property is a bit up and down. Everyone keeps saying there's a crash coming, and yeah, there might be a crash coming, but it tends to always, crash and then come back again. Your returns compound over a period of time. So you've actually got that whole thing of, compounding interest that Warren Buffett talks about, and allows you to be a lot more strategic in what you're doing. You can look at a much more long-term picture of your investments, like the Norwegian sovereign fund, for example, which, has got an immense amount of cash in it. And it makes investments very, very much on, providing the best return on investment for the Norwegian government that can then provide amazing returns for its population. But short term, which is a lot more like venture capital and private equity tends to be, quicker returns. No private equity firm wants to hold on to a great big a project for 10 years, right? They don't want to own 10 years worth of Virgin Australia or 10 years of Maya or 10 years of a retail arm. They want to be able to get it, either fix it or break it out for parts to get the biggest return they possibly can based upon what they paid to get in there. They pay $1 billion to get in, like Bain Capital did with Virgin Australia. They want to be able to get out for a lot more than $1 billion, considering they've already spent what, 4 years, so 2020 through to now, 4 years with that. They're probably looking in the next year to be able to offload that either through an initial public offering on the Australian Stock Exchange, which returns Virgin Australia back to the stock exchange and to the public markets, or they will sell it off wholesale to someone else or in pieces, whatever it takes to get that money back. Now, it does mean there's a bit of volatility there because there's different appetites for investors. So it might not be the year to release something, though we've just seen a very, very successful release, on the stock exchange very, very recently by Guzman and Gomez, for instance, had an amazing initial debut on the Australian Stock Exchange. So we've seen that it is possible, but at the same time, that really good news can turn to bad news very quickly on the stock market. And the short term tends to look at what the trends are right now, and we'll make very small tactical adjustments to the way it operates and the way that the business might operate, and the business may do its revenue planning or its model for a business for conducting its business can be made very, very quickly. Whereas those longer term investments, that tends to be more institutional, more like your superannuation funds, etc., that want to be in much safer places over the long term. So when it comes to disruption and value creation, we're talking about that ability to disrupt traditional markets. We're very interested in new technologies and business models that will do something different, change consumer preferences, change the market dynamic. We want to look at value creation for people. So improving things in the operations of a business, improving the efficiencies, improving the cost structures that make the business more successful, generating new revenue streams. I think there's an amazing opportunity for businesses of all sizes to find additional revenue streams with the assets they already have. They've got a bricks and mortar venue. It's not getting used at certain hours of the day. What can they do with that? What can they actually find that will produce some kind of revenue? Also, the investor decision-making and valuation play is about increasing that emphasis on the long-term growth potential. Now, we don't necessarily have a long-term investment strategy around a particular business, but we will certainly look at it as a whole of fund perspective and say, well, yeah, we will adapt to different things in order to protect long-term results up to 10 years of the investments that we make. Although generally, venture capital firms like to be in and out without about 5 years, but that could go longer if there's a really strong investment to be made. The rule at the end of the day, as Warren Buffett would say, never lose money, and never forget rule number one. Basically, you want to do something that's going to make you money. Now, there are also plenty of impact businesses, impact investments. We're not talking about ignoring all that. We're saying about the very beginning of it, that triple bottom line of having financial stability plus social impact plus an environmental play as well. That triple bottom line still needs to be underpinned by businesses that are profitable and making money. That's what pays for the rest of it. So thank you so much for joining me on today's webinar. We've got more of these coming up in the next couple of weeks. Please do stick around. If you like what you saw, you'll see it again on YouTube just after this. It takes me about 15 minutes to get it ready and uploaded. So thank you, and I'll see you in the next one.